Hello and welcome back. This is the second in the lectures on money supply economics and how that affects the banking system. I'm presuming obviously that you've seen the first one. I won't cover everything again. So let's continue with our discussion. I was discussing last time the concept of having a constant money supply. I would just say now that it's not always an easy, even if we wanted to do that, it's not necessarily an easy thing to achieve, but you can certainly get very close to it with things like managing interest rates and just controlling the amount of bank lending. There are good economic reasons why a money supply, constant money supply is a good thing. The first one is, although there will be, if there's a constant money supply, there will be a higher interest rate because money will be scarcer to borrow than it was before. At least during, if you don't have a constant money supply, you get this boom and bust cycle. Now, during the busts, interest rates might be high, but during the booms they'd be low. In our scenario, with a constant money supply, interest rates would be kind of far more constant, but they would probably be higher. But that's not a problem, because prices are falling. So the fixed amount of borrowing will be able to buy more and more. The second thing is that because interest rates are higher, there won't be so many bad projects being funded. So one of the problems with the boom bust is you've suddenly got lots of easy money and you fund lots of projects that then fail. And so lots of money is actually wasted, and that's why you get the bust, because you've destroyed all this economic productivity. That doesn't happen in a constant money supply. So first of all, you don't get the boom and bust, and secondly, you don't get the business failures at the same rate. No inflation means no distortion of prices. If you don't have, what happens with money supply is it goes, when it's increased, it goes into the economy in an uneven way. So business people, factories, service providers are under the impression that there's more demand for their product, but it's purely a monetary phenomenon. People have more money, they spend more, but when that new money disappears, they're not spending more. So all that you've just built a new factory to meet the demand, or you've hired lots of extra employees to meet the service demand, and then it collapses. So you have this dislocation, you've got distortion in the economy, which destroys value and destroys economic growth. So you've got a much more stable situation. So money, productivity rather, production, investment will be much more stable. It will be much less distorted, and it'll be much more predictable, which is good for business. In zero money supply, there's no need for currency control, and so far less crises. The other thing that happens with increases in money, which are usually uneven, is that the currency varies a lot more. If a zero money supply growth country would probably have an appreciating currency, other things being equal, against many other currencies. So stronger currency, which Germany's had for a long time, and it's been good for it. It does discipline businesses to be more efficient, but it also means you don't have wild currency fluctuations, just like you don't have wild fluctuations of business cycles, boom and bust. There's an economist called Barrow, B-A-R-R-O, who wrote a book called Getting It Right about more than 10 years ago, who did an empirical study of over 100 countries between 1960 and 1990. A 10% drop in inflation rate translates into an increase of growth of between 0.2 and 0.3%. So he said if during the 1960 to 1990 period, the UK had lowered its annual inflation rate, which was 7.7 to 2.5, so that's a drop of 5%, then its GDP growth would have been 0.1 to 0.12% higher. That would have raised the average income in Britain over that period by 54%, so people in Britain would have been 50%. And these are small changes. I mean, in South Africa, our average inflation rate over the last 30 years has probably been double that. So we could have had much greater growth than we've had, everything else staying the same. just by keeping our money supply constant. In that period, from 1960 to 1990, Britain went from being the 10th to the 17th richest country in the world. If everything else had stayed the same, and it had adopted this policy, it would have been the richest. So just a little bit of extra growth can make a huge difference to incomes. That's why economic growth is so important to solving poverty and so many other problems, because obviously the more money you have in your, the more wealth, I should say, you have in your economy, the more you can spend on anything: environment, helping the poor, washing machines, dishwashers, chairs, whatever you want. So growth of wealth is important. Barrow also concluded there's no support for the idea that you hear a lot, that inflation has to be tolerated to ensure increased output and employment. All too often, higher interest rates not only fail to reduce growth, all too often lower interest rates not only fail to boost growth, but reduce savings, decreasing the availability of funds to lend out. So people would say, well, you need these low interest rates which create this money supply growth and the boom and bust cycle in order to help businesses to grow. But it also reduces the amount of people saving, so the amount of money available to businesses to grow. And he didn't find any empirical relationship between the two things. Falling prices, people say that falling prices is deflation, and deflation is a problem. Deflation is a name for two different things that get confused. One is the falling amount of money supply. So if the money, I'm arguing for constant money supply growth. I agree that deflationary, when the money supply is contracting, is a problem, which is what happens when there's a bank run, which is what happened in 1929, which is why the American government have been pumping huge amounts of money into the economy, quantitative easing, to stop bank runs, to stop deflation. What they should have done is what Ludwig von Mises, the economist, said was nothing sooner. So they shouldn't have created the boom, and then they wouldn't have had a bust. So these are the reasons, or many of the reasons, why a constant money supply will be beneficial. There's one more, and that's that inflation is basically theft. If you increase the money supply, you're increasing and some people use the new money, get the money lent to them and they can use it at cheap interest rates. But everybody else's money is becoming worth less. So that's basically theft. It's taking money away from everyone by making it being worth less. So it's a moral reason. Increasing the money supply is actually a form of stealing. Okay, so let's leave that there for now. We'll just continue our discussion on money supply economics in the next lecture. Thank you.